What is goodwill? Goodwill is an intangible asset that arises as a result of a premium value paid for a target's fair market value net identifiable assets in a stock transaction. Now, net identifiable assets is the difference between shareholders' equity and the existing goodwill for the target company. So for a stock sale transaction, how do you calculate goodwill? When the purchase price of a stock sale exceeds the net identifiable assets of the target, the difference between shareholders' equity less existing goodwill, the excess is first allocated to the target's tangible and intangible assets, which are written up to their fair market value. And that's why we said fair market net identifiable assets. Now, the written up value allocated to the tangible and intangible assets is then multiplied by the company's tax rate to get the deferred tax liability. The calculation itself, how we calculate goodwill, is we start with our equity purchase price. You then subtract the target's net identifiable assets, then the written up value for both tangible and intangible assets, and then add back the deferred tax liability to get total goodwill. So you have our equity purchase price, we subtract the target's net identifiable assets, so shareholders' equity less existing goodwill. We then look at the difference between the two so that we can write up any of the existing assets, whether tangible or intangible, to their fair market value. Those written up values, the difference between the book value and the fair market value, for both are then subtracted from the equity purchase price, and then we add back the deferred tax liability to get the total goodwill created in the transaction. So a better way to look at it, equity purchase price minus the net identifiable assets minus the written up value of tangible and intangible assets from book value to fair market value. Then the deferred tax liability that's created by that written up value is added back to get goodwill, which is created in the transaction. So how do you calculate the deferred tax liability? We kind of said it already, but let's just focus on it. So once the target's tangible and intangible assets have been written up to their fair market value, the sum of this written up value is multiplied by the company's tax rate to get the deferred tax liability, the DTL, for the transaction. So the tangible asset, the written up value, and the intangible asset written up value gives you the total asset write up. You multiply that by the company's tax rate, which in this case is 38%, to give you the deferred tax liability. That's how you calculate the DTL, and that's added in the goodwill calculation.